This is Luqman Rafiq here. The topic that I am going to be discussing today is with respect to IAS to inventory. So whenever we talk about IAS to inventory, we do know that the inventory is to be recorded at the lower of cost or NRV. The objective of this video is to discuss about the complications, the problems that arise with respect to the NRV evaluation and the specific guideline that is available in IAS to inventory. So before I move forward to discuss about the complication, I am going to have a quick recall of the topic of the inventory valuation, and then I am going to talk about the problems that arise with respect to NRV. Firstly, when we talk about the measurement of inventory as per IAS 2, so IAS 2 tells us that the inventory has to be recorded at the lower of its cost and the net realizable value. It's not the not realizable value, it's the net realizable value. That's what you have to do. Now, if you have to measure the inventory at the lower of cost or net realizable value, so what is included in the cost of the inventory? So the cost of the inventory includes the purchase price. The cost of the inventory includes the conversion cost. And what exactly do we mean by conversion cost? The conversion cost includes the direct labor and the overheads. So generally, when we talk about the inventory valuation, so the cost of the inventory is the purchase price plus the conversion cost. That's what the cost of inventory is. When it comes to the net realizable value, so net realizable value NRV has got this specific formula. And what is that specific formula of the NRV? So the formula of NRV is like this: estimated selling price less estimated cost to be incurred to bring the inventory into saleable condition, and the third one of them is estimated selling cost. I am going to explain this NRV through an example. Assume that I am talking about an oil refinery. Assume that I am talking about an oil refinery. With respect to the oil refinery, what happens is the oil refinery, what it does is it converts the crude oil. It converts the crude oil into different types of products, and those different types of products could be diesel, could be gasoline, could be kerosene, etc., 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 etc. Now let's talk about that. For example, if a refinery has input some of the crude oil in the manufacturing process and it wants to extract the gasoline, so how exactly are we going to establish the net realizable value of that gasoline? So the first thing that you are going to do is you're going to establish the estimated selling price. That if I manufacture that gasoline, what is going to be the ultimate selling price of this gasoline? Assume that the ultimate selling price of the gasoline is expected to be $50. The second thing is, present state of the crude oil is that the crude oil is in the refining process. It's not converted into gasoline. So how much is the cost that I need to incur in order to convert this crude oil into gasoline? Assume that you would say that you might have to incur a cost of, let's say, $20 in order to convert this crude oil into gasoline. So if you have to incur a cost of $20, and we need to now also establish that what is going to be the estimated selling cost which will be incurred in order to enable the sale of this inventory. So assume that the estimated selling cost is going to be $7. On the basis of this, what is going to happen is you will get a $50 as the estimated selling price. $20 is the extra cost to bring this inventory into saleable condition, and this $7 is the cost that would be incurred in order to make the sale of this inventory. So resultingly, we would end up getting $23 as the NRV. So if the cost of this specific item is, let's say, $20, and if the NRV is $23, so what is going to happen is you will continue to measure it at the cost of $20. That is what you are going to do. Now, this is the basic concept of the inventory valuation, which is that inventory is to be recorded at the lower of cost or NRV. Now what I am going to do is I will be discussing about that if there are changes with respect to NRV, if there are changes with respect to the market value of the inventory, how do we deal with the changes in the market value of the inventory? I am going to discuss that in the coming examples. So the first concept that I'll discuss is that, for example, assume that the crude oil inventory that you have, the cost of that crude oil inventory was $50 a barrel. The cost of that crude oil inventory was $50 a barrel. And now what has happened is the market value of the crude oil has gone down to $45 a barrel. So now the question mark that arises is, should I write down the inventory? So a very important thing is discussed in IAS to inventory, and that is that what you need to do is that you need to perform an evaluation that what is it that you sell? What is it that you sell? Do you sell crude oil? Or do you sell the products out of this crude oil like gasoline, etc., etc., etc.? Assume that you say that we are a refinery, we don't sell crude oil. We instead sell the products which is gasoline, diesel, kerosene. This is what we sell. Okay. So what you need to do is that you need to have an evaluation of whether the ultimate selling price of this gasoline has gone down or not. I take an example that the gasoline was being sold at 2.35. The gasoline was sold at $2.35 a gallon. And even when the crude oil prices went down, the gasoline is being continuously sold at $2.35 a barrel. So since you are ultimately going to be selling this gasoline and not the crude oil, therefore even if the market value of the crude oil has gone down, this does not require an inventory write down. Now, a second concept. Assume that the gasoline was originally sold at $2.35 a gallon, and now after this reduction in the prices of crude oil, the gasoline's market value has become $2.28 per gallon. So if the market price of the ultimate finished goods, the market price of the ultimate product that we sell has gone down, then therefore that would mean that we might have to review that whether we should write down the raw material to the NRV or not. So this is one specific concept that you have to discuss with respect to the NRV, that in case if the market value of the raw material moves, how would we deal with it? Now let's move on to discuss another concept with respect to NRV. You do know that whenever we talk about the concept of listed companies, so listed companies have to prepare quarterly financial statements. Listed companies have to prepare quarterly financial statements. So every quarter they have to prepare a financial statement. Now what happens is, a listed company had an inventory of, there is an oil marketing company. What do you mean by oil marketing companies? Companies like Shell, they are oil marketing companies, they sell oil. So assume that Shell had reserves of gasoline, and the cost of the gasoline that was incurred to buy it was, let's say, $2.2 a gallon. Now what happens is, the NRV of this gasoline has become $2.05. So what is Shell going to do? As per the IFRS, Shell is required to write down this inventory of gasoline to $2.05 because inventory is to be recorded at the lower of cost or NRV. So there is going to be a $0.15 write down in the inventory. Now, what happens is, because of XYZ reason, the inventory was not sold. And if because of XYZ reason the inventory was not sold, there comes a reporting date, let's say maybe Q1 of the next year. And what happens is, the market value of the gasoline has now become $2.25. So a question mark that arises is, we need to measure the inventory at the lower of cost or NRV. So is there a possibility that I can reverse? Is there a possibility that I can reverse the loss that I initially recognized on this inventory? So as per the IAS 2, yes, you can reverse it. Now, can I reverse it? Yes, you can reverse it. Because IAS 2 says inventory is to be recorded at the lower of cost or NRV. Your cost is 2.2. You had written it down to NRV of 2.05. So resultingly your carrying amount is 2.05. Having a carrying amount of 2.05 does not mean that the cost has become 2.05. The cost remains 2.2. So if now the NRV has become 2.25, so what could happen is, since you originally recognize a loss of 0.15, so therefore what could happen is you can recognize a gain of 0.15. So what could happen is, even if the market value of the inventory is 2.25, you cannot measure it at 2.25, you can actually take it to $2.20. So what we have discussed through this example is that in case if there is a write down in the inventory, can that write down be reversed? Yes, it can be reversed. To what extent it can be reversed? It can be reversed to the extent of the loss, to the extent of the write down that was previously recognized. So the objective of this video was to discuss about those concepts of NRV valuation, inventory valuation, which are usually not clear to many students. So I have discussed with you people two of the concepts, which is, one of them is, if the market value of the raw material goes down, then how would you treat it? And secondly, if the value of the inventory goes down and subsequently the NRV reversal takes place, so how would you deal with this situation? Hopefully these videos would have made quite a lot of things clear to you people. Thank you very much. Hopefully inshallah soon, very soon, another video is going to come up to discuss further issues in accounting and financial reporting. Thank you.